Every great investment bubble begins with the same sentence. This time is different. People said it before the dot-com crash. They said it before the 2008 financial crisis. And today, they're saying it about artificial intelligence. But here's what almost nobody is talking about. The world's smartest investors aren't just chasing the AI revolution anymore. Some of them are quietly preparing for what comes after it. Not because AI is fake, not because the technology won't change the world, but because history has a habit of rewarding innovation, while punishing investors who arrive too late. And right now, there are warning signs appearing across the market that most people haven't even noticed. The strange part? On their own, they don't seem dangerous, but once you connect them together, they reveal a completely different picture. A picture that's appeared before some of the biggest market crashes in history. A picture that has wiped out trillions of dollars in wealth. And a picture that could determine whether the next decade grows your portfolio or becomes an expensive lesson you'll never forget. Because here's something I've learned after studying decades of market history. The biggest investment opportunities rarely appear when everyone is excited, and the biggest risks rarely announce themselves with flashing warning signs. Instead, they hide behind optimism, behind headlines, behind record-breaking stock prices, and behind the belief that this time, somehow, the rules no longer apply. So I started asking myself a simple question. If AI really is the greatest investment opportunity of our generation, why are some of the smartest investors in the world becoming increasingly cautious? What are they seeing that everyone else seems to be ignoring? The answer isn't hidden inside complicated financial models. It isn't buried in earnings reports, and it isn't something you'll hear on most financial news channels. It's hiding in a pattern that's repeated itself throughout modern market history. Once before the dot-com bubble, again before the housing crash, again during the SPAC frenzy, and today. The exact same pattern is quietly forming around AI. Now, that doesn't automatically mean a crash is coming tomorrow. Nobody knows that. Anyone who claims they can predict the exact day a market will crash is selling confidence, not certainty. But smart investors don't wait for certainty. They watch probabilities. They study patterns, because by the time the evidence becomes obvious to everyone, the opportunity to protect yourself has usually disappeared. So today we're going to follow the evidence. Not predictions, not fear, not hype, just the facts. Because by the end of this video, you'll understand why some of the smartest investors are all paying attention to the same warning, and why ignoring it could become one of the most expensive financial mistakes of this decade. Most people believe investing is about finding the next great company. Find the next Apple, the next Amazon, the next Nvidia. Buy early, hold for years, and eventually you'll build wealth. It's simple advice, and in many ways, it's absolutely true. But there's one part of the story almost nobody talks about. A great company doesn't automatically make a great investment. That sounds backwards. After all, if a business keeps growing, shouldn't its stock keep rising too? Not necessarily. Because when you buy a stock, you're not buying the company it is today. You're buying the expectations of what everyone believes it will become tomorrow. And expectations can become incredibly expensive. Imagine someone tells you there's a restaurant so incredible that people wait 6 hours just to get a table. Naturally, you'd expect an amazing meal. But what if dinner costs $10,000? Suddenly, the question changes. The restaurant might still be fantastic. But is it worth that price? That's exactly how the stock market works. The quality of the business matters. But the price you pay matters just as much, sometimes even more. History has taught us this lesson again and again. The companies weren't the problem. The expectations were. Take the dot-com boom. The internet was one of the greatest inventions in modern history. It completely transformed communication, shopping, entertainment, and business. anyone who believed the internet would change the world was right. But many investors still lost fortunes. Not because they picked the wrong technology, because they paid prices that assumed decades of perfect growth. Reality simply couldn't keep up. The same thing happened during the housing boom. People weren't wrong to believe homes were valuable. Homes are valuable. The mistake was believing prices could only move in one direction. Eventually, reality caught up. It always does, and that's why professional investors spend less time asking, "Is this a great company?" and much more time asking, "Has everyone already figured that out?" Because once the entire world agrees something is amazing, the opportunity may already be gone. This brings us to something I found incredibly interesting. Whenever markets become convinced they've discovered the future, the people closest to that future often start behaving very differently from everyone else. Not what they say, what they do. That's an important distinction. Because words are cheap, money isn't. When executives, founders, early investors, and institutions begin making similar decisions at the same time, experienced investors pay attention. Not because insiders are always right, but because incentives rarely lie. And over the past few decades, that pattern has appeared with surprising consistency. Before major market peaks, optimism reaches its highest level. Financial media becomes overwhelmingly positive. Retail investors rush in. New investment products appear almost every week. Valuations climb to levels that seem impossible until they climb even higher. Everything feels unstoppable. That's usually when experienced investors stop asking, "How much more can I make?" and start asking, "What risk is everyone else ignoring?" Because successful investing isn't just about recognizing opportunity. It's about recognizing when everyone else is looking in exactly the same direction. And right now, that's exactly what's happening with artificial intelligence. But before we decide whether that's a reason to be excited or a reason to be careful, there's one historical pattern you need to see first, because once you notice it, you'll start seeing today's market through a completely different lens. If you want to understand where today's market could be headed, you have to stop looking at today's headlines and start looking at yesterday's patterns, because markets change, technology changes, industries change, but human behavior? That barely changes at all. Think about it. In every generation, investors become convinced they found something that changes the rules forever. The railroad, electricity, the internet, housing, cryptocurrency, and now, artificial intelligence. Every one of these innovations transformed the world. But here's the part people conveniently forget. Almost every one of them also created a period where investors became far too optimistic. Not because the technology was fake, but because expectations grew faster than reality ever could. Take the dot-com era. By the late 1990s, the internet wasn't just exciting, it was unstoppable. Every company wanted .com in its name. Investors poured money into businesses with little revenue and sometimes no clear path to profit. It didn't matter. The story was enough. The biggest question isn't whether AI will change the world. It almost certainly will. The real question is whether today's stock prices already assume a future that's almost impossible to achieve, because that's where expectations become dangerous. When I started comparing today's AI boom with previous market cycles, I noticed something surprisingly familiar. It wasn't just the excitement. It wasn't just the soaring valuations. It was the behavior of the people closest to the industry. Founders, executives, venture capital firms, and early investors weren't just building AI companies. They were also finding ways to sell ownership to the public. At first, that sounds completely normal, until you ask one simple question. If the opportunity ahead is truly extraordinary, why are the people with the most information so eager to sell part of it today? The answer isn't that they think AI will fail. It's that great investors understand something many people don't. A great company doesn't automatically make a great investment. Price always matters. Think about your dream house. If it's worth $500,000, you'd probably love to own it. But if someone asked you to pay $5 million, would it still be a good investment? Probably not. The house didn't change. The price did. The same principle applies to the stock market. Investors often fall in love with a story and forget to question the price they're paying for it. Markets don't just reward great businesses. They reward businesses that exceed expectations. And when expectations become too high, even an incredible company can disappoint investors. That's why the smartest investors don't spend their time trying to predict exactly when the market will rise or fall. They prepare for multiple outcomes. They diversify. They manage risk, because they know that preserving wealth is just as important as creating it. History has repeated this lesson for decades. Every generation believes they've found an opportunity that changes the rules forever. Yet, somehow, the same rules always return. Valuations matter, profits matter, cash flow matters, and eventually, reality always catches up with expectations. So, before you invest in any exciting new trend, whether it's AI, crypto, or the next revolutionary technology, ask yourself one question. Am I investing because I truly understand the opportunity, or because I'm afraid of missing it? That single question could save you from one of the biggest investing mistakes you'll ever make. Because in the end, the investors who build lasting wealth aren't the ones who follow the crowd. They're the ones who stay rational while everyone else gets emotional.